So today we're going to talk about 5 UK stocks that have crashed. These stocks are down a huge amount and are 5 stocks that are actually quite high up on my watch list. Now there's a lot of UK stocks out there at the moment that are having really good buying opportunities. It seems like the US markets at the moment, especially this week, I thought this week after that inflation data, it would be quite an ugly week, but we even finished quite strong on the Friday. And the US markets have kind of been a bit flat for the last few weeks, whereas the UK market just seems to be going lower and lower and lower, and it's presenting some really good opportunities in the UK market. So I'm going to talk about 5 stocks that I'm really interested in, but there's plenty more. I know a few of you guys are interested in the likes of Royal Mail, Dunelm, B&M, for example. I've heard a few of you guys talk about them in the comment section, but I'll talk about 5 ones that I'm interested in, and as well as that, I'm going to squeeze a little bit of an update as well in this about one stock, which I'll leave until we get to it. But I know a few of you guys on the Discord wanted me to talk about it, especially you, Neil. So this one is for you, and we're going to take a look at these 5 stocks and see if they're good opportunities. So hope you enjoyed the video. We'll take a look at these 5 UK stocks. So the first stock up is DS Smith. So this is a UK company that is, if you don't know, is a packaging company. So obviously with a packaging company, with the e-commerce boom, you'll know that this is probably quite a safe play. You know, there's not much that will affect it. Sure, there might be times where it's a bit of a peak and a bit of a slump, but it's a pretty safe company. It's listed on the London FTSE 100, which obviously is our main index, and at a 3.8 billion market cap, that's actually quite a big size for a UK company. Obviously, if we were talking about a US stock, that would actually be quite a small company. But yeah, over the last 5 years, there's not much share price action going on. As you can see here, but at the moment you see some from the 3rd of September, it was £4.46 and it is down over 37%. And because of that, I think it has a little bit of potential for a little bit of price appreciation at 13 times earnings, and as well as that, you're going to be picking a bit of a heftier dividend yield up at 5.3%. So I think that this is not going to be a stock that is ever going to go crazy. You know, it's not going to give you crazy amounts of share price appreciation. But for a very stable dividend stock that, you know, pays you a 5% rate, is not too bad at all. So like I said, DS Smith is a packaging company. If we look at how the company's doing at the moment, you can see here that there's been a little bit of a boom up since that kind of CV period, probably a bit more of a switch to online spending. But if you look at the past performance, you can see it's pretty consistent. They kind of stick around that 3-4% profit margins, and the revenue has slightly increased. I'm sure that's just naturally putting prices up and a few more clients more than anything, but obviously nothing too crazy, but it has slightly ticked up in the right direction. And you see the same for profit. You know, profit doesn't grow at crazy rates, but it just slowly goes in the right direction. So yeah, you know, obviously not something that's going to offer you crazy amounts of gains, but a very stable and safe stock, potentially one that it could be a bit of an interest. Financial health wise, it's pretty healthy as well. You can see here that they're actually paying down debt. So they had around 3 years ago 2.7 billion in debt. They've actually got 2.1 now. So that debt is getting paid down from 88% debt to equity down to 50% debt to equity. Ownership wise, there's a little bit of buying going on, which is obviously great. Obviously, it's a positive sign if insiders are buying the company right now, and you can see that especially through June, there's been a bit of buying at the moment. So yeah, DS Smith is an interesting one for a very safe play, healthy dividend. I think the payout rate is also pretty good. If we just have a look at this dividend here, you'll be able to see that if we look at the dividend history, you can see that the dividend has slowly been hiked up in a good way over the last few years and is forecast to continue. And I think it's quite well covered on the payout rate. You can see here it's about 42%, which is good. So yeah, a stock that's not going to give you crazy amounts of share price gain, but I think maybe at 13 times earnings could be slightly undervalued. Quite a decent 5% dividend yield is a pretty safe stock that could be quite interesting. Personally for me, I don't know if I'll buy it just because I think it just doesn't have as much growth as what I'd like. You know, even when I get a dividend stock, I want to have a little bit of growth here. But for a safe play, the way you can collect a pretty decent dividend at quite a high yield while it's on this dip could be an interesting one. So that's the first one, DS Smith. Second one, Pets at Home. This one was actually pointed out to me by Matty, which most of you guys probably know him, on the Discord a couple of weeks back, and I thought actually it's a pretty decent opportunity that we have here with this one. Same again, this one is like we talked about, you know, so many UK stocks have fallen off the cliff in the last few weeks. 17th of September, since then it's lost 42% since 17th of September 2021. Now trades at 11 times earnings, has a 4.1% dividend yield. And this one I would say is probably a little bit more interesting because I think the valuation's lower. Sure, the dividends are slightly less, but I think the potential growth in the future could be a little bit more for this company. So for someone that would like a bit more growth and potentially give you a bit more share price appreciation, as you can see here that it has been on from around 2018, yeah, it could be that. And there's been a bit of a turnaround inside the company, and that's why it's kind of had a bit more of a run up. Most of you guys will know Pets at Home. Obviously, they sell a lot of animal products, and then also kind of expanding a little bit more into its range. So some of the new things are like Vets for Pets, Groom Room, VIP Club, pet insurance, flea subscriptions, pet sitting, pub and kitten club. So these are the little kind of incomes it's kind of building up more, rather than just being that kind of store that sells just pet products or potentially the actual pets. Having a bit more of a SaaS income building up right now, and these are the new products that it's launching to kind of get that income coming in. And when you look at the valuation, like I said, 11 times earnings, it's not too bad at all. If we look at the growth, let's go on the past growth to start with. Look at the, really I would say since 2017, that kind of improvement. And with that improvement, what you're seeing here is, you look here, the kind of SaaS models is really improving the profit margin. You'll see that this profit margin is slightly starting to increase, which is great. Also, you can see the amount of profit as well is doubling up, which is great. And also the revenue has had a massive increase. So you can see that kind of improvement and that turnaround in the company really coming into the financials here. And if we look at the future growth, you can see that analysts are also quite bullish once again on the kind of revenue increase that's going to go on, and potentially that profit increase as well, as we go forward through that expansion plan. So yeah, that's a pretty good, interesting play here. And I think if it does deliver this sort of growth in the next few years, like I said, I think it doesn't really deserve to be like at 11 times earnings. So I think, you could potentially say that it should be potentially between a 15-20 times earnings. Also, collecting a 4% dividend yield, which isn't too bad at all. And when you look at the dividend yield as well, it's pretty well covered at 30% as well, which is pretty good. So yeah, a pretty good one to keep an eye on. It's probably also worth saying that I think they have recently had a CEO change recently. I think they're also currently buying back shares as well, which obviously is a bonus. You can see the recent results that are out here were pretty strong. Group revenue was up pretty good. Retail revenue was good. And you can see the other parts of the business that they're really starting to improve on, which was the vet group revenue up 17% and the fee income as well, up 20% as well, which is a space that they can obviously continue to grow at good rates. And also you can see that some of the new clubs that they've been building up here with the numbers, you can see that they're actually pretty strong growth as well for them new income streams that they're starting to build up. So I'll leave that there for you to read if you want to. So that's quite an interesting one. And the third one on this list is a stock that I mentioned before. It's one that's quite high up on my watch list, which is Revolution Beauty. And I keep watching this one and it just keeps going lower and lower and lower. At some point I might have to be buying this one. It's currently trading down at 64p. It came on the stock market around about last year now, around about £1.70. So since that time frame, you see the stock is down 60%. And at 205 million is quite tempting. Now, if you don't know what Revolution Beauty is, they sell a lot of makeup products. From what I've seen, the products are pretty good. From the people that I've asked that use them, they say they're pretty good as well. And when you look at the sales, you look at the expansion, especially in the US side of it, they seem to be doing very well with the partnerships and sales as well going forward. When you look at the recent earnings as well, they were pretty good. Financial year 2022, sales up 42%. Adjusted EBITDA up 73% and record sales in Q4, which is obviously pretty strong. The record Q4 was from new global retail partnerships. So you see here Boots and Walgreens, which was a really big growth driver for them, especially in the US side of it. And also the rest of the world is coming back quite strong as well. So when you look at the financial side of it, they've had really good amounts of growth previously. It'd be interesting to see if they can keep this growth up. Now, forecast-wise from analysts, there's only one person covering it at the moment, but they are expecting, once again, a big, massive jump up on the revenue here, which will be pretty good. And at a 200 million market cap, for example, if they do 11 million in profit, that would actually put them at a pretty attractive valuation. And especially if they can keep ramping that up towards, 20 billion in the not so far in the future, if you talk 3, 4, 5 years down the line. If they start doing 20 million profit with this sort of growth at 200 million market cap, it's a pretty good valuation for this company, especially when you consider the growth side of it. And when you look at the financial health, it's not too bad on the financial health part of it. Obviously, the IPO helped. They've got 4 million in debt, and they're currently sitting on 21 million in cash, which is pretty healthy. And their owners still have a good stake in the company. It's also a founder-led company as well, which is obviously a positive. And really, the only risk that I see to this is how competitive the industry can be. Obviously, as we know, the makeup space can be quite not much loyalty. It's a very competitive market, so that's the only concern I do have with this one. But when you do look at companies like Elf recently in their earnings and Ultra Beauty as well, if you can get it right, it seems like you can have very long-term success in this market. So yeah, that's the other thing that puts me off. But when you do weigh up the growth, the brand, the management team here, it's quite an interesting opportunity. So I am very close to potentially buying that one. We'll see what happens. The next one, which a lot of you guys on Discord asked me to just do a bit of a cover on, which is National Express. So this is the only one that I actually do own that's on this list. This one has been hurt a lot recently. You can see here that actually pre-CV, it was actually around £4.50. And the company was doing absolutely amazing as well financially. CV situation comes, especially travel stocks, boom, major amounts of value lost, especially around the September time. Look at this. And then we had a bit of a recovery, and then since then, around the kind of April time, 2021, the stock has just been going lower and lower and lower. It's down 50% right now. And actually, when you look at that, there's times during the peak CV where it's actually lower than right now. Even like the 3rd of April 2020, it's actually lower than then. The only time it's actually up on is like the peak day of fear in that CV situation, and kind of around that kind of September time before we kind of got this vaccine news. So shows you how much National Express is actually really beating down at these sort of levels. It's a 1 billion market cap company currently at the moment. And if you don't know what National Express do, they do a lot of travel, not just in the UK. Quite often people get them just confused as the coach company in the UK. They do a lot of the travel in the UK, but they're actually international. They have a lot of major contracts for their services in Europe and America. So yeah, they're actually a worldwide company with a lot of different services that they do offer. Now, the recent earnings update for National Express was actually pretty positive. So this was the 7th of June. So revenue is very close to the 2019 pre-pandemic levels, and expected around 2.7 billion. You can see here that ALSA revenue is recovering very strong and is 15% of pre-pandemic levels. UK revenue is starting to get there, but you can see it's actually 85% of pre-pandemic levels. So this is something that is holding the company back at the moment. This needs to recover a little bit more than what it was doing, but I think that will happen when you consider the disruption that's out there right now, the cost of travel, I think, and also people more willing to go away and traveling to go away. I think the UK will recover back at some point. That's the only thing that's been a little bit slow to recover. German rail revenue is nearly 4 times pre-pandemic levels. So this is kind of one of the new major contracts they won just before the CV situation that's doing really well. In North America, shuttle revenue is about 90% of pre-pandemic levels, so that's starting to get there. You can see here that they reinstated their short-term margin guidance, so the medium term that the group is confident in delivering at least 1 billion of revenue growth from 2022 to 2027. So that will be a really good amount of growth if they can deliver that. And you can see here they want to keep an average profit margin of 9%, which will be pretty good if they can carry on doing that. Now, they did say that there could be some short-term hits on the profitability. I don't know if this is what's kind of really spooking the market with this one, that the profitability might be down in the short term with a few of the issues that are going on, which they do list here. But you can see here that the group is, really capitalizing on the new contracts they've been winning. And without doubt, as soon as we kind of, maximize or recover fully with a few of the issues here, the company's been winning a load of contracts, and especially international wise, and really benefited from them. So yeah, in the long term, I still think the revenue will come back really strong as it has been doing. And I think when they kind of manage these issues on the profitability, the company will go back to doing good amounts of profit. And you can see here that actually puts us about level where we're at pre-pandemic on revenue basis. Obviously not the same on the profit side of it, but that should recover as some of these issues are solved, and we should go back to doing some decent amounts of revenue growth, and that profit should recover, like they said previously, to that kind of like 9% profit margins, which would be great. And obviously a 1 billion market cap company, if we start talking about a business here that gets back to doing 100 million profit, not a bad valuation. And if we can get to the long-term projections of, let's say 200 million in profit, at 1.1 billion market cap. That's a pretty good going. So the growth is really good, the valuation is really good. The balance sheet, same again, is a little bit heavier on the debt side, as you would probably expect when you're having to run a business like this and have, you know, all the vehicles to do it. So the debt is obviously a little bit high. Hopefully they can reduce that, which I think they did say was one of the aims actually. But they've still got 580 million in cash, which is pretty healthy. Recently as well, the CFO did pick up some shares, which is pretty good. So yeah, everything with National Express, I'm looking at thinking, yeah, there's a little bit of a hit on the profitability in the short term, which I think they'll solve in the long term. But, you know, the company's still, you know, winning major contracts, putting them contracts into good amounts of revenue growth, and there's still a little bit of recovery to go here, which it will eventually recover. So, yeah, I think this business is going to be in not too long in a better place than the CV situation it was in. If it wasn't for a lot of these issues going on in the world right now, it probably would have been. And yeah, I think there's a lot of upside here. So yeah, I think the National Express in the next few years will obviously easily become a 2 billion market cap company. I think it's just a question of whether it's going to be a 3 or 4 billion market cap company in the next few years. So yeah, I think that I potentially could pick up some National Express shares in the future at the moment, because I think to be down at the kind of the CV levels here is a little bit stupid. And the last one is Flutter. So this is an online betting company, bit of a rival to the DraftKings, obviously, as you guys probably know. So Flutter, if we have a look at their share price, has been pretty much killed off like a lot of the online sports betting companies. They're just not in favour at the moment. And Flutter have obviously got, unlike DraftKings, which is a newer company in the space, a bit of a track record. You know, they've been a company that's been around for a long time. Obviously, they've been on the stock market since 2010. And these guys have a track record of obviously being a successful business, but also they're ones that are moving into the US market and the growth there. You look at the company right now, it sits around about the March time 2021, the stock is down 55%. And if you look at the brands that they own, obviously FanDuel, which is the growth driver for them as online sports betting in America is allowed, that's what's going to obviously drive the growth for them in the next few years. But you know, the likes of Sky Bet, Sportsbet, Paddy Power, PokerStars, Betfair, they've got loads of brands. I'm sure you've heard most of these brands that they currently do own. So yeah, they've got kind of the classic kind of markets for betting, but also they're entering obviously this new US growth area with the brands of like FanDuel, for example. And when you look at the recent earnings, you can see here there was good amounts of single digit growth here. A lot of this was actually pulled down by negative growth in their kind of more developed markets, you can see here. So, you know, ex-US growth was actually down. So that's obviously bit more slower growth in their markets because they're more mature, but the US market is the major growth driver for them. So if you look at the US side of it on this FanDuel base, you know, that was growing 45%, and you can see here that the US market is basically nearly the size of the UK market already, and obviously the US market is a brand new area, so that US is going to be massive in the next few years. Now, when you look at the financial performance of Flutter, you can see here that the company historically grew at okay rates, but especially look at the growth that it's starting to put in right now. It's really big amounts of growth that it's going to have. And as that US growth carries on maturing, which is still very early days like DraftKings, but when it gets bigger and bigger and bigger, that overtakes like the UK side of it, this company is going to have, you know, really big amounts of growth. Now, they did slip out of profitability, as you can see here recently, and that's due to expansion in the US. They've done a lot of acquisitions recently as well, but that will solve itself out in the next few months. They were investments that needed to be happen for Flutter to do well in the US. But in the next coming few years, you know, that's going to drive more and more revenue growth going forward. It's going to drive good amounts of profit here going forward. So when you work out a 13 billion market valuation and they still start putting in good amounts of profit, you know, this company starts doing, you know, on average, you know, let's say 20% revenue growth. It's a pretty good valuation, and that's going to happen in the US side of it as well, which is really good. Now, the company does have a little bit of debt here, but 35% debt to equity is not too bad. They do sit on 951 million in cash, and there has been some insider buying as well, but it is not a founder-led company like DraftKings, and there's also not big ownership in the company like DraftKings. But like I said, if you wanted a little bit more risk and not really like, you know, it has the more mature parts of the company to kind of help it generate good amounts of profit going forward, and still have a decent amount of growth and have exposure to the US kind of online betting boom that will happen. I think Flutter's quite an interesting one. I think for me personally, I'd rather own the one that's just a pure play in the US because that's where the growth is. But if you wanted to have something that's a bit more profitable and kind of expose you to that US market, I think it's quite an interesting one, especially when you consider it's nearly having as much as a drop as DraftKings. Well, maybe not as much as a drop of DraftKings, but still 55% is quite a big drop off at the moment. So yeah, that's quite an interesting one anyway. So I hope you enjoyed it. A bit of a long one today, wasn't it? But I hope you enjoyed it anyway, guys, and I'll catch you in a bit.